Welcome to TheoTrade. This is Don Kaufman. Here we are. It's August 29th, 2016, doing the Theo Night video. First, we're going to take a quick glance at some of the intraday trade today as the S&P futures are kind of breaking to the upside. However, we've got about 15 minutes left in the trading day, and they're fading as I speak right now. We're also going to talk a little bit about a few levels in the broader market. And number two, I'm going to show you a trade that we did today inside of Bank of America, why we did the trade and the setup on that particular trade. So let's start again with the S&P futures, which are currently up 10 handles, that is 10 points. We're trading to 21.78 and change. Now, if you tuned in to the weekend TheoTrade update, I mentioned two very specific levels in the marketplace, and I'm going to kind of enunciate those in a little bit more detail now by bringing up, all right, an intraday chart for the last 30 days. Intraday, 30 days, 1 hour. I'm going to go ahead and as I bring that up, I'm also going to kind of supersize the screen over here. And what I was actually mentioning on that is where most of the trade has persisted, okay, for the past 30 days. It's actually longer than that now. It's we're going on to 34 days without a 1% move. Now, most of that trade has actually persisted right inside this window. That window is equivalent, I'll be very specific about this, one of the levels to the downside happens to be roughly 2160. Okay, so we're going to look at the 2160 level. To the upside over here happens to be 2180. Now, through trade last Friday, when we crossed 2180, the volume absolutely exploded outside of this range over here because there's a huge amount, okay, of risk outside the 2180 range. If you spend 30 days, most of your trade is inside of a 20-point range. All it does, again, is accumulates risk. So on Friday, we got a quick look-see. We traded outside 2180. The risk exploded. The hedging activity went nuts. We also saw on Friday, trading down to the 2160 level, risk exploded. Sure enough, there's a tremendous risk that exists outside of this window. Well, today was no different. Today was actually more evidence on this particular front. So we'll cruise back over now to a 1 minute. And I want you to see some of the volume in today's trade. The volume has been minuscule, right? So if you are kind of looking at volume here with me, zoom in. Some of the volume candles are tough to see, but you zoom in. Any given point today, we were lucky to be doing about 2,000 contracts a minute. And I'm telling you, this stuff matters to kind of enunciate levels. If I zoom specifically in, there's a few minutes though. We traded, 10, 11,000 contracts, which roughly means all hands on deck. Things are going to get crazy out there. If you take a look at the levels specifically, the moment we hit 2180 and right up into the level, okay, of 2180, we spiked on volume. Again, more evidence that there's this immense risk that exists inside that window in the S&Ps. Ironically, where do you think we're lining up to close today? It should be no surprise that we're going to close in and around 2179. I mean, it's getting a little old now that we've been locked inside this 20-point range for 34 trading days. This today will actually make it 35 trading days because it doesn't look like a whole lot is going to happen. Now, looking down the list, the one thing that stands out today, the NASDAQ, it's weak. I want to see if there's follow through to that. The thing that's perplexing me, and I don't mind hopping on a video here in the evening and talking about something that perplexes me in the market. You got bonds up. Big. You actually had bonds up at one point today, 2 full points. And typically when you get bonds up, that means the rates associated with them. Okay, and I'm actually going to switch to a full-blown 9-month chart over here. And if you are looking at a full-blown 9-month chart on the bond futures, make sure you adjust for contract changes as the bonds just saw a roll. But the bonds are up huge today. Big, big move. Again, bonds up, the interest rate associated with them would be down. That typically hurts financials. How ironic that financials are leading the market higher today. The XLF actually feels like it's breaking out, which leads me to a trade. Well, I didn't do the trade specifically to the XLF. Why? Because I found something that outperformed the XLF. and that happened to be Bank of America. And it's something I pointed out, again, over the weekend. I found me a trade in Bank of America. I looked at Bank of America. I looked at JP Morgan, Citi, Morgan Stanley, all the usual suspects, even Goldman Sachs. Bank of America set up for the trade, okay, the most effectively. So here we go into Bank of America. Again, 10 minutes left to play in the period. Looks like the S&Ps are going to end up the day about 10. I'm going to open up the 32-day options, okay? And I did a spread, a bearish spread. Why? Well, again, here we have Bank of America kind of breaking out to the upside. Now, today's little breakout may have been met with a little bit of failure. This is, could this be the infamous doji hammer? I'm just kidding. I'm really not that much into technicals. But if you are a technical trader, and I know that many of you guys that tune into these nightly videos are a little bit more technical traders, I'm going to give it to you from a technical standpoint, because if you're kind of curious why I did the trade, if you looked at something like momentum indicators or something like an RSI, RSI is going to be pegged to the upside. It's absolutely going to be pegged to the upside, but it does look like the momentum of this move is kind of waning. Anyway, that isn't the reason that I did the trade. I'm a quantitative trader, right? But again, I want to appease those that are going to ask me about the technicals. And if you are into technicals, if you look at like a 6-month over here, and I'll zoom in for you, I can read it. This is actually a version of an RSI. Okay, it's a version of an RSI with a different time function, right? And you can see it's absolutely pegged. And over here, we actually have fractal energy. Fractal energy is pegged to the bottom of its move, which basically means all the energy is out of that particular move, yada, yada, yada. I did a bearish trade. The reason, again, if you're curious, the reason I did the bearish trade, statistically speaking, this underlying has moved, okay, far beyond its statistical means. For example, if a stock says that over the next month it's supposed to be able to move $1, and that stock moves $2, it moved roughly 2 times its standard deviation. Well, that's the situation that led me to Bank of America. It's statistically stretched in terms of a move. Okay, so I go in and I put on a bearish spread. The bearish spread that I've actually constructed is a 16.5. Okay, close this up. The 16.5. 15.5 put spread. Now, earlier in the day, I executed these trades for 50 cents. Now, again, for 50 cents, that's a dollar-wide spread that you're paying 50 cents for. I don't like to typically do a dollar-wide spread. Why did I do a dollar-wide spread? It's a 16.5, 15.5. I'm purchasing it for 50 cents. Why did I do a dollar-wide spread? Because it's a $15 underlying. And a $15 underlying, all right, only has an expected move. And again, this is the stuff that to me statistically matters. The expected move in here is about $1. Do a $2 wide spread probably wouldn't make sense, because statistically speaking, it's only enabling itself right now to move about $1. So I go out and I'm going to pay 50 cents for this, and I'm going to try to exit making about 55% on my 50 cents, which is, again, this is not like windfall profitability. Either that or it could be windfall profitability. 55% is 55%. You do however many contracts that you might be comfortable with. You can see, and we blasted this trade out earlier today, and you can see about over 980 some odd contracts traded at this particular spread. I think it's a decent setup. Fact of the matter is, though, if you're going to do a trade like this, you do not want to pay 56 cents. That's where it's currently trading. If the stock bounces up tomorrow, make sure that you pay 50 cents or less for this spread, right? And again, pricing matters. Every single penny out there matters. It is a bearish spread inside of a Bank of America. For me, it's much more of a statistical means of why I kind of constructed the trade, seeing that Bank of America looked like it had kind of exhausted its moves, statistically speaking. Again, here's an underlying that's expected to move about $1 in 32 days. What did it really do? Moved a substantial amount above and beyond that. It's about 1.7 deviations inside a very short time window. Nevertheless, a bearish trade inside of Bank of America. Get that thing for 50 cents or less. S&Ps here, just minutes to go to the close, up 10 in what has been kind of another lackluster day. But again, if there's confusion, it's for me inside of the bond market. How do the bonds rally? Interest rates come off in the financials. do well. Tell you what, there's more action going on to this market than really meets the eye. Stay tuned all this week here to TheoTrade. Be back on throughout the course of the week with a couple of trade ideas and much more about markets. Have a great evening. Bye-bye.